Hello and welcome to chapter 23, which is basically talking about variance of actual versus budget and whether that variance is a favorable variance or an unfavorable variance. So I've got two practice problems in this particular chapter. One is going to wind up being an income statement showing actual to budgeted, and then the other one I'm going to actually get into variances of direct material, direct labor, and variable overhead. But we'll tackle one at a time. So let's start with this. We have a practice problem here. Phoenix Company's 2015 master budget included the following fixed budget report. This is a fixed budget based on expected production and sales volume of 15,000 units. So we're assuming this was sales at 15,000 units. Okay. Now the problem with the fixed budget is it's made for 15,000 units. Last chapter we did a master budget based on an assumed number of units that we thought were going to sell for each month. This one's fixed at 15,000. The problem with this is if we actually sold, say, 16,000 units or 17,000 units or 18,000 units, that would mean that the corresponding expense would go over what was budgeted, and we'd get beat up for going over budget on our expenses. However, our sales budget will be greatly increased. It will be favorable. And so it's basically a double-edged sword. You made good money on sales, but yet you got a shellacking on the budget side of it. Now, most companies have gotten to the point where they understand that this is true. But I'll tell you, sometimes in the nonprofit areas, they fail to see that. And so you do run into a little bit of interference as far as that one is concerned. So let's see. First order of business is to classify all items listed in the fixed budget as variable or fixed. So we had to go through each of these and find out if they're variable expenses or fixed expenses, and also determine their amounts per unit or their amounts for the year as appropriate. So we start going down the list. Sales is going to be variable, direct materials variable, direct labor is variable, machine repair is called variable, depreciation, straight line, that is fixed. So I'm going to put a check mark by that as being fixed. Utilities, 45,000 is variable, but the rest of the 195,000 is fixed. So I need to split that out into two things. So 45,000 variable, and then the balance of that is going to be 150,000 fixed. So that was a mixed expense on utilities. Plant management salaries, well, salaries are the same no matter how many hours you work, so that will be considered fixed. Put a check mark by that. Packaging, shipping, those are going to be variable because they'll go up and down depending on how many things you sell or ship out. Sales salary, fixed. Advertising expense generally is fixed. Salaries here is fixed. Entertainment expense, according to the author, entertainment expense is considered fixed. So my guess is that the boss will allow some element of entertainment, okay, and that is rather fixed. I'm going to put a dash line by utilities because that's a mixed, and the rest of these with a solid line are considered fixed expenses. So this is going to wind up looking like this. I'm not going to write it all out, but I'm going to show you that if I take my sales of 3 million, I divide that by 15,000 units, I will get $200 per unit. Okay? If I do the same thing for the others, 975,000 divided by 15,000 units will give me $65 per unit. 225,000 for direct labor divided by 15,000 units will give me 15,000 per unit. 60,000 for machine repair divided by 15,000 is going to give me $4 per unit. Utilities, this is only the 45,000 that I have to worry about, so that divided by 15,000 is going to be $3 per unit. The rest of the utilities right down here is 150,000, which falls under fixed costs, which is what I put it under fixed cost. Plant manager salaries, 200,000 fixed. Packaging is variable, so 75 divided by 15 is going to be $5 per unit. And then shipping, 105 divided by 15, $7 per unit. So these are all my variable expenses and my variable sales. Everything else, sales salary, 250, advertising, 125, and salary is here for 241, and entertainment expense for 90,000. So my total fixed cost will be 1,356,000. My total variable cost is $99 per unit. My total sales is $200 per unit. So if I were to come up with a contribution margin here, just like we did last chapter when we did cost, volume, profit, my contribution margin between 299 is going to be $101. That's my contribution margin per unit. Okay, contribution margin, 101,000. Okay, that was question number 1. Next, question number 2, prepare flexible budgets. For the company, it sells volume of 14,000 and 16,000 units. So I'm going to wind up not writing this whole thing out. I'm going to show you the answer, but I'm walking you through where all the numbers came from. So I'm going to set this over here. And here we have the flexible budgets at 14,000 and 16,000 units. Now, you'll notice everything's been transcribed from here over to the income statement. So these are the per unit amounts, and we're going to take these per unit amounts and multiply them by 14,000 to come up with all these dollar amounts all the way down here. And we'll take the per unit amounts and multiply them by 16,000 units to come up with these dollar amounts. Okay? And then, of course, my fixed expenses, which I just simply translated everything over from here to the other, these stay the same. They don't change. They are fixed, okay? So no matter what, the difference in activity, fixed cost is fixed cost. Okay, we answered number 2. We set up flexible budgets for 14,000 units volume and 16,000 units volume. Number 3, now we have a hypothetical situation. The company's business conditions are improving. One possible result is a sales volume of 18,000 units. The company president is confident that this volume is within the relevant range of existing capacity. So he's saying that fixed costs will stay the same within the range, which is upwards to 18,000 units, and can go as low as 15,000 units, and fixed costs will not be affected by it. Okay? How much would operating income increase over the 2015 budgeted amount of 159,000 if this level is reached without increasing capacity? Now, 159,000, that is basically what was income, and that shows it right here. Here's income from operations, 159,000 for 2015 budgeted amount. So now we need to look to see at 15,000 units, what would 18,000 units do? How much over this would 18,000 units production go? Okay, and so we look over here We start with increasing from 15 to 18,000 units in sales volume. And so the possible sales in units, 18,000 units, and we're going to multiply this by $101. Where did that come from? Well, that's my contribution margin. If you remember over here, I took the 200 in sales, I subtracted 9,900 in variable cost, and I arrived at $101 contribution margin. So that contribution margin will increase with the number of units because that is a variable. Okay, we learned that in cost volume profit analysis. So I have a total contribution margin of 1,818,000. I subtract fixed costs. I got the fixed costs from my schedule right over here. 1,356,000. That was all my fixed costs, which does not change. Still is the same amount. And I come up now with an operating income of 462,000. But then I got to pull out the income from my 2015 budget, and that tells me that my increase is going to be an income increase of $303,000. Okay, so that's the answer. Now, of course, do you have to do all this? You could take the shortcut. Take the difference between 15,000 and 18,000 units, 3,000 right there, and multiply it by the contribution margin. You still come up with the same number. Well, how'd that happen? You don't have to worry about the fixed cost because fixed cost is going to be the same whether you do 15,000 or 18,000. So all you have to do is just multiply by the contribution margin itself, and you come up with a difference in net income. Because however many dollars contribution margin goes up, it goes up the same amount of dollars for net income. Why? Because fixed cost did not change. Okay, now we take a look at problem number 4. An unfavorable change in business is remotely possible, okay, like we're doing right now. In this case, production and sales volume for 2015 could fall to 12,000 units. How much income or loss from operations would occur if sales volume falls to this level? Well, we do the same thing as we did up here. We come down here, we take a look, we have 12,000 units, we multiply that by our contribution margin per unit, which is $101. I pointed out how we came up with that. And we arrive at total contribution margin of 1,212,000. We subtract from that 1,356,000, which is the same fixed cost that we had arrived at earlier. Okay, my total fixed cost 1,356,000 is going to be the same thing here, and unfortunately, we take a loss at operations. Okay, and then when that happens, usually layoffs follow shortly thereafter as a very quick fix to bring this back to a break even. That concludes chapter the 23-1 problem. Thank you.